Hello dear students, welcome back. Today we are going to do question number 5th of question number 5th. Machine account shows balance of rupees 60,000 in the books of Mehta Limited on 1st April 2012. This machine was purchased 5 years back. Till today, total depreciation written off on this machine was of rupees 20,000. On 1st Jan 2014, second machine was purchased for rupees 12,000. Second machine was not found suitable and sold at 10% loss of book value on 31st December 2014. From the above information, prepare machine account and depreciation account in the books of company up to 31st March 2015. So let's start with the calculation. Here first, let us see the amount of annual depreciation for first machine. Here, point to be noted that here we are not given original cost of first machine. Here it is given that first machine shows balance of rupees 60,000 on 1st April 2012, and here it is given that this machine was purchased 5 years back and total amount of depreciation written off till today, it is given that is rupees 20,000. So in order to find out amount of annual depreciation, we will divide 20,000, that is total amount of depreciation till today, up divided by 5 years, as this machine was purchased 5 years back. That means if for 5 years the total amount of depreciation is 20,000, so what would be the amount of depreciation of 1 year, that is annual depreciation? So here if we divide 20,000 by 5, we will get rupees 4,000, that is the amount of annual depreciation. Now let us see calculation for selling price of second machine and depreciation of second machine. Here it is given in the question that the second machine was purchased on 1st January 2014. That means in the accounting year that begins from 1st April 2013 and ends on 31st March 2014. So in this year, we will not calculate depreciation for whole year, because this machine was purchased in this accounting year on 1st January 2014. So here we will charge depreciation for 3 months only, that is from 1st Jan 2014 to 31st March 2014, where this year ends. So here in the question it is given that we have to provide depreciation at 5% under straight line method. So if we calculate this, that is 12,000 multiplied by 3 upon 12 multiplied by 5 upon 100, we will get 150. So here 150 is the amount of depreciation in the accounting year that begins from 1st April 2013 and ends on 31st March 2014. And if we deduct it, we will get 11,850. That is the book value as on 1st April 2014, or we can say that it is the closing balance at the end of the accounting year 2013-14. So now in the next year that begins from 1st April 2014 and ends on 31st March 2015. In this year also we will not provide full year depreciation. Here we will provide depreciation for 9 months only, that is from 1st April 2014 to 31st December 2014, as it is given in the question that this machine was sold on 31st December 2014. So there are 9 months from 1st April 2014 to 31st December 2014. So this machine, in this year we have utilized this machine for 9 months. That means we have this machine in this year for 9 months only. So here if we calculate it, we will get 450. That is the amount of depreciation at the end of this year. If we deduct it from 11,000 from 11,850, we will get book value, that is book value as on 31st December 2014, that is 11,400. Now it is given in the question that this machine was sold at 10% loss of book value on 31st December 2014. So here we have book value as on 31st December 2014, that is 11,400, and if we calculate loss, 10%, so here we get 1,140. We will deduct it as this is loss in order to get selling price. So when we deduct 11,000, when we deduct 1,140 from 11,400, we will get 10,260, which is our selling price. So here we have completed calculation for selling price of second machine. Now we will prepare depreciation account. So here for the first year, that begins from 1st April 2012 and ends on 31st March 2013. In this year, we had only first machine, and for which depreciation amount was rupees 4,000. So here 4,000 will be recorded on debit side of depreciation account. So here we will record it, and in particular column we will write the name of the account having corresponding credit effect, that is machine account. So here we will write to machine account. If we pass journal entry for this, the journal entry for this would be depreciation account debit to machine account. So its corresponding credit effect is machine account. So here in particular column we will write to machine account, and as we charge depreciation at the end of every year, so here the date is 31st March 2013. That is the last date of this accounting year. Now we will transfer depreciation amount to profit and loss account. So here we will record it on credit side of depreciation account. Amount is rupees 4,000, and in particular column we will write by profit and loss account. Date is 31st March 2013. Similarly, in second year also, here depreciation of first machine is rupees 4,000. Here we have utilized first machine in all the 3 years. So here every year the depreciation amount would remain same, that is 4,000. So here depreciation amount for first machine is rupees 4,000, and in this accounting year depreciation for the second machine was rupees 150. So 4,000 plus 150, that comes to 4,150. That is the total amount of depreciation. So here we will record it on debit side. In particular column we will write to machine account. Date is last date of the second accounting year, that is 31st March 2014. Again we will transfer this amount to profit and loss account. Amount is 4,150. Similarly, in the third year we will charge depreciation, and here depreciation amount for the first machine, that is 4,000, and depreciation amount of second machine in this year was rupees 450. So 4,000 plus 450, that comes to 4,450. So we will record it on debit side of machine account. on of depreciation account, and in particular column we will write to machine account. Date is 31st March 2015. Again we will transfer it to profit and loss account. Date is 31st March 2015. In this way we will prepare depreciation account. Now let us see how machine account will be prepared. Here now we will prepare machine account. Here 60,000 is given, which is the balance of machine account on 1st April 2012. So here we will write to balance brought down instead of to bank account or cash account, as this is not the purchase price of machine. Now at the end of this year we will charge depreciation, that is rupees 4,000. So we will show it on credit side of machine account. Then here total of here amount in debit side is more, that is 60,000, and if we deduct 4,000 from 60,000 we will get 56,000, that is closing balance at the end of this year. So here we will write by balance carried down at date 31st March 2013. Now this will be called as opening balance of second year, new time period. So here we will write date, the starting date of the second accounting year, that is 1st April 2013. So here we will record it on debit side 56,000. Then in this accounting year that begins from 1st April 2013 and ends on 31st March 2014, in this year we have purchased second machine for rupees 12,000. So here we will record it on debit side, and in particular column we will write to bank account, date 1st Jan 2014. Now in the second year we will charge depreciation. So here depreciation for the first machine is rupees 4,000 and for the second machine it is rupees 150. So total depreciation is 4,150, which will be recorded on credit side of machine account. Again we will close this. So here we will find out a balancing figure, that is closing balance at the end of this year, that is 63,850. Here we will write by balance carried down. Now this balance will be called as opening balance of the next period, that is for the third year. So here we will write to balance brought down, date 1st April 2014. Here it is 63,850. Now here, as we have sold second machine on 31st December 2014, so here on this date depreciation is rupees 450 that we just calculated. Now as we have sold this, so here we will record it on credit side of machine account as per the rule of real account. Here machine is going out of business, so here we will write it on credit side. Amount is 10,260, that is selling price, and here in particular column we will write by bank account, that is a name of the account having corresponding debit effect. Then we have sold it at 10% loss. So here as it is loss, so we will show it on credit side of machine account. Amount is 1,140. Then again we will charge depreciation for the first machine, that is rupees 4,000. Date is 31st March 2015. First machine was with us in the third year for the whole year. So here whole year depreciation will be provided for the first machine, that is rupees 4,000. Then now we will find balancing figure, that is debit amount in debit side, that is 63,850, and we will deduct the amounts in credit side. So here we will find out balancing figure, that is 48,000, that is closing balance of machine at the end of third year. So in this way we will prepare machine account. I hope it is clear to you all. Now let us see next question, question number 6. Rajkumar Limited had purchased some machines for rupees 82,000 on 1st April 2012. The installation expense of this machine was rupees 8,000. On 1st October 2014, company purchased another machine for rupees 70,000 and their installation expense was rupees 2,000. Company provides depreciation at 10% every year under straight line method. 30% machines from first purchase were sold at 20% profit of book value on 31st March 2015. From the above information, prepare machine account up to 31st March 2015 as well as show accounting effect in annual accounts of each year. So let us see calculation first. Here, machine purchased on 1st April 2012 is 82,000 and installation expense is also given that we will add to purchase price, that is 8,000. So 82,000 plus 8,000, that comes to 90,000. So here, as this is straight line method, so under this method here we will calculate depreciation on cost price. So here 3 years depreciation, that comes to 27,000. That is cost price is 90,000 and 10% depreciation, that comes to 9,000. And if we multiply it for by 3 years, we will get 27,000. Now, if we deduct depreciation of 3 years, here we will get 63,000. That is book value as on 31st March 2015. Here you can notice that this machine was purchased on 1st April 2012. And here we need to find out book value as on 31st March 2015, as it is given in the question that this machine was sold at 20% profit of book value on 31st March 2015. And as this is straight line method and we have utilized this machine for full 3 years, so here we have directly deducted total depreciation of 3 years, that is rupees 27,000 from cost price in order to find out book value as on 31st March 2015. Now further it is given that 30% machine from first purchase were sold at 20% profit of book value on 31st March 2015. So 30% machine, that is here book value as on 31st March 2015 is 63,000 and only 30% part is sold. So here that means only 30% portion is sold. So here 30% of 63,000 is 18,900, and as it is sold on 20% profit, so 20% of 18,900 is 3,780, and as it is sold on profit, so we will add it in order to find out selling price of the machine, that comes to 22,680. Now here we will provide depreciation for first purchased on first purchase machine, that comes to 72,000 multiplied by 10 upon 100 multiplied by 6 upon 12, that comes to 3,600. Here we are charging depreciation for 6 months only for second machine, as it is given in the question that this machine was purchased on 1st October 2014 in the accounting year that begins from 1st April 2014 and ends on 31st March 2015. So 6 months depreciation, that means we have utilized this machine for only 6 months, as we have purchased it on 1st October. So from 1st October 2014 to 31st March 2015, there are 6 months. So here we will provide depreciation on this machine for 6 months only. That comes to 3,600. So here in this question also, you have to prepare machine account, and you have to show accounting effect in annual accounts of each year. So that is your homework. I hope it is clear to you all the calculation of depreciation. So that's all for today. Thank you very much.